For decades, Japan was not just a major economic power, but also a top foreign holder of U.S. Treasury bonds. This was no accident. It was a deliberate strategy by Japanese policymakers to keep the yen weak, making Japanese exports more competitive on the global stage. By holding vast amounts of U.S. debt, Japan could help ensure its products remained affordable abroad, fueling its own economic engine. This approach didn't just benefit Japan. It also gave the United States a reliable, steady buyer for its government debt, which helped keep American interest rates low and borrowing costs manageable. The relationship was mutually beneficial. Japan's export-driven growth soared, while the U.S. enjoyed economic stability and a strong demand for its bonds. Japan's massive bond purchases became a cornerstone of global finance, signaling unwavering confidence in the U.S. dollar and reinforcing its status as the world's reserve currency. This trust helped stabilize international markets and encouraged other nations to follow suit. The cycle was straightforward. Japan sold goods to the U.S., earned dollars, and then recycled those dollars back into U.S. Treasury bonds. This created a powerful feedback loop that supported both economies. This loop provided crucial liquidity and stability to global markets, supporting economic expansion and prosperity on both sides of the Pacific. It was a win-win situation that underpinned decades of growth. But this relationship was built on Japan's persistent deflation and near-zero interest rates, which made U.S. bonds especially attractive compared to domestic investments. As long as Japan's economy struggled with low inflation, buying U.S. debt made sense. Now, as Japan's economy begins to shift and inflation slowly returns, the logic behind this decades-long strategy is starting to unravel. Policymakers are rethinking their approach. The once unbreakable cycle that linked Japan and the U.S. is now facing uncertainty, raising questions about the future of this financial partnership. Japan's reevaluation of its U.S. bond holdings could send ripples through the global financial system, potentially disrupting a partnership that has shaped the world economy for generations. Japan is now selling off U.S. Treasury bonds, a move that's sending ripples through the global financial system. For decades, Japan has been one of the largest foreign holders of U.S. debt, quietly supporting the American economy by purchasing massive amounts of Treasury bonds. But now that long-standing relationship is changing. This signals a major shift in priorities for Japan's policymakers, who are rethinking how to best protect their own economy in a rapidly changing world. Rising inflation at home is forcing the Bank of Japan to tighten monetary policy, making it more expensive to borrow and spend. The cost of living is climbing, and Japanese households are feeling the squeeze. At the same time, the government needs to fund domestic stimulus programs to support growth, but it's wary of adding to its already massive national debt. By selling U.S. bonds, Japan frees up cash to inject into its own economy, marking a significant pivot inward and prioritizing national stability over international investment. This move comes at a time when the U.S. is facing its own economic crisis, with rising interest rates and fears of recession, making Japan's decision even more disruptive for global markets. For Japan, it's a matter of self-preservation, protecting its economy and people from further shocks. For the U.S., however, it means losing a key financial backer at a critical moment, raising concerns about how it will fund its growing deficits. Even a partial sell-off by Japan can shake global markets, causing uncertainty and sudden swings in bond prices and currencies. Investors and central banks around the world are watching every move, bracing for increased volatility and the possibility of further instability. The era of Japan as a limitless buyer of U.S. debt is over, marking the end of a financial partnership that has lasted for generations. The U.S. must now adapt to a world where this crucial source of funding is no longer guaranteed, forcing policymakers to rethink their strategies for economic stability and growth. Japan's bond sell-off is sending shockwaves through the global financial system, and the effects are being felt most acutely in the United States. The sudden move is hitting U.S. financial markets hard, sparking anxiety among investors and traders alike. As Japan floods the markets with U.S. treasuries, bond prices tumble and yields surge. This means the U.S. government, along with businesses and everyday consumers, now faces higher borrowing costs, making it more expensive to finance everything from homes to major infrastructure projects. Higher interest rates threaten to slow economic growth, forcing policymakers and business leaders to make tough decisions about spending, investment, and hiring. As Japan converts its dollar holdings back to yen, the US dollar weakens. This makes imported goods more expensive for American consumers, adding to inflationary pressures already straining household budgets. The risk of stagflation, where the economy slows but prices keep rising, now looms larger than ever, threatening jobs and business stability. Investors are rattled. The long-standing safe haven reputation of U.S. Treasuries is suddenly in doubt, shaking confidence in the world's largest bond market. Stock markets are experiencing wild swings as fears of higher rates and a slowing economy ripple through Wall Street, making the investment landscape more unpredictable. For decades, Japan's steady buying of U.S. debt helped stabilize the financial system. Now, with that support fading, real uncertainty is taking hold. The ripple effects are global, impacting markets and economies far beyond America's borders, and raising concerns about worldwide financial stability. The U.S. must now confront a new era of unpredictability, where old assumptions no longer hold, and the path forward is anything but certain. The yen carry trade, borrowing cheap yen to invest abroad, once pumped liquidity into global markets. With Japan's rates rising, this strategy is collapsing. Investors are unwinding positions, selling U.S. assets, and converting proceeds back to yen. This reversal drains liquidity, intensifying market turmoil worldwide. The end of the carry trade is a key reason for recent market losses. Risk appetite is fading fast as uncertainty grows. A policy shift in Tokyo now has immediate severe consequences for markets everywhere. The world is feeling the pain of Japan's normalization. A fundamental shift in global money flows is underway. All eyes are on the U.S. Federal Reserve to stabilize markets. The Fed is expected to cut interest rates and possibly restart quantitative easing, injecting cash to replace lost Japanese liquidity. This intervention aims to restore confidence and keep credit flowing. The challenge act decisively without reigniting inflation. The Fed's mandate to maintain stability and employment makes a strong response likely. But pumping money into the system risks further weakening the dollar and raising prices. The immediate priority is to prevent a financial meltdown, even if it means higher inflation later. The Fed's actions will shape the next phase of the crisis. Economic turmoil is colliding with U.S. election politics. With a presidential race looming, policymakers are under pressure to stabilize the economy fast. Expect coordinated action, Fed rate cuts, government stimulus, and direct support for consumers and businesses. Political urgency may override debt concerns in the short term. This backstop could calm markets and limit panic selling. The crisis may trigger a new wave of stimulus, setting the stage for recovery. The next months will be volatile, but massive intervention could spark a rebound. Political will to avoid recession is a powerful force in this environment. Today's crisis is a severe but temporary market dislocation, not a permanent breakdown. The end of Japan's liquidity cycle is forcing the U.S. to step in as the world's main liquidity provider. Aggressive monetary and fiscal stimulus is likely, setting up the next major upswing. What feels like disaster now could be the start of renewed growth. The sell-off may offer opportunities for long-term investors. Focus on long-term trends, not short-term panic. The global financial system is realigning, but policy response remains strong. The next liquidity cycle led by the U.S. could define markets for years to come.